Hi, my name is Yasha and I help young men invest in the stock market. So today we are going to take a look at this extremely famous coffee brand. It's called the Starbucks Corporation with the stock ticker SBUX. And if you are wondering whether you should maybe buy Starbucks or if you have stocks, should you sell or not, or maybe if you are just wondering, how to analyze stocks as general, then this video is perfect for you, okay? Because as always, we are going to analyze Starbucks using this little Canva presentation that I have right now here. So let's begin, okay? First of all, why should you even listen to me? As you know, my name is Yasha and I help young men invest in the stock market. And when you have more trust for me, the first link in the description will take you to my one-to-one coaching for stock market. Now, with that being said, let's proceed with the analysis. So this is going to be very beginner friendly, quick, straightforward, with a lot of facts. You will learn a lot. So grab a piece of paper, grab a pen and write some notes down. And now let's begin, okay? So as a complete beginner, whenever you analyze stocks, you should care about the following 6 things, okay? You should care about chart, profit, debt, money on the bank account, value, and price. Now here are some quick facts about Starbucks. So it's a coffee shop or coffee brand, whatever. It was founded in 1971 and it's famous worldwide, okay? You probably also drink coffee here, so you know the deal, okay? And here is immediately the first thing that I want you to take a look at, okay? Whenever you analyze or whenever you want to invest in stocks, you should pay attention to when they were established, okay? So Starbucks was established in 1971. And as a rule of thumb, the older the company is, the better it is as an investment and also the safer it is, okay? Because let's assume that some unexpected event happens, that in 1 year we have a crisis, okay? And the older the company is, the generally the higher it has the chances that it will survive additional future crises, okay? Because if they are so long already on the market since 1970, that's like 50 years. So if Starbucks is already 50 years on the market, then they survived quite a few crises already, okay? And that's why they have higher chance that they will survive another in the future as well. But if you have some startup company that was founded maybe 1 year ago or 2 years ago, for them, we don't know if they will survive the crisis or not, because so far they haven't been in one crisis yet, because they were established like last year, and last year nothing happened, So as a rule of thumb, okay, generally the older the company is, the better and the safest it is as an investment, okay, because they are established, they are long term on the market. You know what I mean, okay? The longer the better. That's the rule of thumb. Now let's proceed with the chart. And for chart, we have an instruction that that chart has to grow for all 10 years, okay? Now, what exactly does that mean? That means that I will draw a little exponential line, kinda like that. And we are going to compare the price chart, which is this orange line, with that black line. And preferably, they should follow each other, because whenever we invest in stocks, we want to see growing chart, because that means that the company is expanding, it's profitable, it's more valuable, the price is going higher and higher, which will bring us more profit in the future, okay? Now let's take a look what do we have here. You can see that the chart is following this black line quite well until around 2022. Then it fell down a bit and it stayed quite low for the rest of that time until now, okay? Now, in my opinion, the chart is still kinda okay, it's growing slowly. So I think I will mark this as a good to go chart, okay? It's nice, it's growing. Obviously right now it fell a bit. Maybe that's a new opportunity to step into the Starbucks and buy it. We don't know that yet, but chart is kinda growing, it's okay, okay? So we are good to go. Now we come to the profit, and for profit we also have an instruction that profit has to be in plus and it has to grow as well. Now here is the very same story as with the chart. I will draw a little exponential line, kinda like that. and we are going to compare whether the profit also follows that line. Does the profit grow exponentially? Yes and no, okay? For example, you take a look here, the growth until 2018 was exponential, it was growing, each profit was higher, but then it kind of became a bit unstable, it went up and down, so profit is not really consistent, it doesn't grow exponentially. Like, this is what we don't want to see. We want to see consistency, we want to see constant growth, which is what we don't see right now here, okay? So profit is not good enough. Now we come to the debt, and for debt we have an instruction that debt has to be low, and preferably it should also decrease through the years. Now here we have exactly the opposite. We have a growing debt, which is generally bad for business, because businesses in their own core are just the same as you are, okay? Think about yourself. If you have high debt, is that good for you or bad for you? Generally, that's bad for you, because that means that you have to make more money in order to repay that debt. And same is with the companies. The more debt they have, the more money they need to produce to repay that debt, and the lower the profit is because of that debt, okay? Now, would you like to have high debt for yourself or not? Obviously not. So here is the same with the company, okay? Starbucks has growing debt, which is what we don't like to see, because we personally also don't want higher debt. So it's that simple, okay? Debt is too high, it's growing, that's a no-go as well. Now we come to the money, and for money, we literally measure money on their bank account, okay? And preferably they should have more money than the costs. Now here is the very same concept as with the debt. The more money you have on your bank account as a person, the better it is for you. That's quite logical. And the same is for the companies. The more money Starbucks has on their bank account, the easier and the better it is for them, because let's say that something unexpected happens, okay? Let's say that one coffee shop from Starbucks gets robbed, you know? What will they do? The stock will fall a bit, because that's bad news on the stock market, so the stock will fall and they will have less profit, but they can still cover all of the costs because of that money that they have on the bank account. You know what I mean? Same is with you. The more money you have, the more relaxed you are, the easier you sleep, more you can afford, more you can do with more money that you have. You know what I mean? It's the same with the companies. The more money they have, the better it is, okay? Now Starbucks has $4 billion on their bank account. Is that good or bad? Use your brain, you are a smart young man. This is amazing, okay? The more money they have, the better, especially like if they have billions, that's amazing. So that's good to go, okay? Now we come to the value, and obviously whenever you invest in the stocks, you want to invest in undervalued stocks, okay? Now, how do we measure valuation? We measure it by two concepts. The first one is so-called P/E ratio, and the second one is called intrinsic value. Now, P/E ratio should always be lower than 15 whenever you analyze stocks, and intrinsic value should be higher than the current stock price. You can find P/E ratio and intrinsic value data on the internet. Just write Starbucks P/E ratio or Starbucks intrinsic value and you find the data online, okay? Now, what exactly is P/E ratio? Let me just quickly explain that to you, because as a beginner, you might not know exactly what we are talking about here. P/E ratio measures if the stock is over or undervalued in comparison to the whole stock market and competitors, okay? Now, P/E ratio of the whole stock market is 15. That's why we want to invest in stocks that have P/E lower than 15, because if the stocks are undervalued, that means that they have the higher chance of growth in the future, because they are below the market. That's quite simple, okay? Now, P/E ratio of Starbucks is currently a bit higher than 15, it's around 22, which means that the stock, based on that, is overvalued in comparison to the stock market, okay? So that's a bad sign for us. Now we come to the intrinsic value, and intrinsic value will sound complicated, but once you understand that, it's actually quite simple concept, okay? Intrinsic value tells you the stock price that Starbucks should have at this exact moment. Should have, okay? Starbucks should have the price of $89 per stock. But currently, their stock price is $79, which means minus $10, okay? So the current stock price is for $10 lower than it should have been. You know what I mean? So intrinsic value actually tells you what price should Starbucks have, but the current price tells you what price they have at this exact moment, okay? And you can see the instruction right now here. Intrinsic value should be higher than the current stock price for stock to be undervalued. Now, intrinsic value is by $10 higher, so that means that the stock is undervalued with intrinsic value. And now you are wondering, is the stock generally over or undervalued? Now we have one kind of overvaluation and one undervaluation. And whenever you analyze stocks, you want to be as harsh as possible when you analyze them, okay? So if you have like one under and one overvaluation, mark the stock as overvalued stock, just to be sure, okay? Because even if in reality it isn't, then that's fine, okay. But if in reality it is, then that's also fine. You know what I'm saying? So be as harsh as possible, because that will give you the most realistic results. And now we come to the stock price, and you can see the instruction that price should be lower than 150 euros. I'm from Europe, I use euros. You are from America probably, so you use dollars, okay? For you it's the same, $150. Now the current Starbucks price is $79, which is below, like by 2 times lower than it should have been. I mean, the maximum border that we have for ourselves. So in terms of the price, the stock is underpriced, okay? That's a good news, because when you are a young man who is investing on the stock market, your budget is very tight, okay? You have maybe $200, $300, $400 that your grandma gave you, and you want to invest all of that money on the stock market. So if you buy one stock that costs $400 or $500, then you blow up the whole budget on that stock. But if you have cheaper stocks, you know, like Starbucks, which costs $80, let's say, that's better, because then you can buy different stocks and you have like a bit of diversified portfolio, you know what I mean? So whenever you have stocks, try to buy them as cheaply as possible. Obviously, don't invest in some stocks that cost 10 cents, because those are crappy companies, okay? Buy normal companies that you may have heard already about them, and so on, you know? But 150 is the border, is the limit when the stock is underpriced or overpriced, okay? Don't go be like above 150, and you will be fine, okay? And now we come to the final evaluation, okay, where we are just going to summarize everything that we found out about Starbucks so far, okay? Now, does the chart grow exponentially? Yes and no, but we still marked it as a good chart, you know, it's kind of growing, so we are good to go here. If you don't believe me, watch the whole video again. Now, does the profit grow as well? Generally, it grows, but the thing is, it's way inconsistent, okay? When we invest in the stock market, we want to see consistency. We want to see slowly growing stocks, because that will give us the profit on the long term. Is the debt decreasing? No, it isn't. Do they have money on the bank account? Yes, they have $4 billion, which is good news for us. Is the stock undervalued? Yes or no? Yes, it isn't. I mean, yes, it is with intrinsic value, but it isn't with P/E. So generally, it's overvalued. And is the price below $150? Yes, it is. Now, should you buy or sell? In my opinion, you should sell, because the financials of Starbucks, even though here in our presentation, in our quick analysis, they seem good, in reality, they are absolutely terrible, and I will show you why. So here we have my detailed analysis that I use for all of the stocks that I invest into, and I want to show you a couple of things. The first thing is retained earnings. Retained earnings represent the money that the company reinvests back into itself instead of paying it as dividends, okay? And the problem becomes when retained earnings are negative. What does that mean? If the retained earnings are negative, that means the company is paying to dividends more money than they get through the profit. So they are actually having more money going out of the company rather than coming inside. And that's extremely unsustainable, bad sign. So just because of that, I wouldn't invest in Starbucks, because they are giving more money than coming in. Just like America, they are giving more and more money, more and more bonuses, more and more, like, I don't know, debt is increasing like 33 billion, no, trillion dollars because of all the free money, you know? Now that has to stop at some point. And here is the same. If they have more money out than coming in, that's completely messed up company. Same with the debt. Look here. If debt to equity ratio is, that basically measures how much money they have in comparison to the debt. So if they have negative debt to equity ratio, that means that they have again more money in the debt rather than money coming in, which is unsustainable again, okay? Same with return on equity. That means how much money they make in comparison to the whole money that they have overall in the company, okay? If it's negative, they have more costs than the money coming in. So that's, as I told you, Starbucks seems like a nice company, but it's completely unsustainable. So in my opinion, I wouldn't buy it. I really wouldn't, because they have crappy business model, really. If you want to know more about stock market investing, click the first link in the description. Join me on this journey by subscribing to my YouTube channel. We will become millionaires with stock market investing together. Do the hard work and see you on top of the world.